Effective risk management strategies in foreign exchange trading. Foreign exchange, Forex, trading is a volatile and dynamic industry that provides the opportunity to profit while also carrying considerable risks. It is critical to execute appropriate risk management tactics in order to succeed in the world of Forex trading. This video covers numerous risk management tactics that can help traders reduce possible losses and enhance their overall trading performance. These tactics are crucial for anyone involved in Forex trading, whether you are a fresher or an experienced trader. Set attainable objectives. Setting clear, attainable trading goals is the first step in risk control. Without well-defined objectives, traders could become victim to overtrading, increasing their risks. Setting realistic profit and loss targets aids in the maintenance of discipline and emotional stability during trading. It is critical to have a well-defined plan and to stick to it. Make use of stop-loss orders. A stop-loss order is a useful instrument that limits your potential losses by defining the price at which you want to terminate a trade. Traders can protect their money and avoid severe losses in turbulent markets by utilizing stop-loss orders. Stop-loss orders must be placed at appropriate levels based on technical analysis and market conditions. Diversify your portfolio. Diversification is a fundamental risk management approach that involves splitting your cash across multiple currency pairs and assets. You lessen the danger of major losses by doing so, since a decline in one position can be offset by gains in another. This method can help protect your whole capital against a single negative market occurrence. Position sizes. Determining the size of your trade positions is crucial for risk management. Never put more money at risk in a single trade than you can afford to lose. A general rule of thumb is to never risk more than 1 to 2% of your whole trading money on a single trade. This method ensures that even a number of losses will not wipe out your account. Risk-reward proportion. The risk-reward ratio is a method for evaluating potential profit versus potential loss in a deal. Aim for a risk-reward ratio of at least 1 to 2 as an initial goal. This means that you want to gain at least $2 in profit for every dollar you are willing to risk, the stop loss. This strategy assures that your profitable transactions may offset your losses, resulting in total profitability. Utilize fundamental and technical analysis. You may make more informed trading decisions by combining technical and fundamental analysis, as discussed in previous video. Technical analysis serves in identifying entry and exit points, whilst fundamental analysis aids in comprehending the larger economic and geopolitical variables that influence currency movements. A thorough analysis technique decreases the chance of rash, high-risk decisions. Regularly monitor and review your trades. Risk management requires consistent monitoring and analysis of your trades. Keep a trading journal to document your decisions, the reasoning behind them, and the results. This practice aids in the identification of patterns in your trading behavior, the refinement of techniques, and the learning from both successful and unsuccessful deals. Conclusion. Foreign exchange trading provides tremendous profit opportunities, but it also carries substantial risks. You can reduce potential losses. Remember that continuous trade monitoring and evaluation are critical for adjusting to changing market conditions and refining your strategy. So in this video we discuss about effective risk management strategies in foreign exchange trading. To know more about Forex markets, stay tuned with us and follow our social media platforms by clicking on link given below.